Hello, I'm Brian Akers. Welcome to the Akers Financial Market Review and Market Outlook for 2022. Yes, we're going to review 2021 and then talk a little bit about 2022. Today's speakers are going to be Alex Monk and Bernie McVeigh. Hopefully you've seen in our pre-show that disclosures about Akers Financial Group. Akers Financial Group, we are financial advisors through an RIA called Kalos Management. And we're also stockbrokers through Kalos Capital and have licenses in life and health insurance and things like that. So this webinar today is designed to talk about the markets, talk about the investment portfolios that we put together at Akers Financial Group. What we have at Akers Financial Group is an investment committee that meets each Monday and talks about the markets and works with Brookstone Capital Management out of Chicago to design our portfolios that we manage with Brookstone called AFG Select Models. Also, we're going to talk about just the market in general, the good, the bad, and what we see coming up in the future. Akers Financial Group, there's a lot of new things happening. Hopefully you've been by our new office. We moved in beginning of September of 2021. And right now we're recording this talk from our radio studio where we're able to record our radio shows live and our webinars in a soundproof booth that was put together at the new office. So today is hopefully an exciting talk about investments, but investments sometimes sound like a little boring. But guess what? Have fun, enjoy the information, and understand that for advisors and professionals are working and handling your money. At Akers Financial Group, our goal is for your money to last a lifetime through a combination of a diversified portfolio with protected assets, along with money that's at risk in the market. But diversification will help us through all of the things that could and might possibly happen in the years to come.
Hello, everyone, and welcome. My name is Alex Monk from Akers Financial Group. Just going to go over our 2022 market outlook and kind of a review of what happened last year. Next, we have some disclosures so that everyone can check those out, just going over who our broker dealer is, who we are, what licenses we have, and whatnot. And Brian will touch more on this later in the presentation. But today, our main thing, we want to go over the market outlook, and that's basically what do we think is going to happen. You know, it's been a crazy year or two, and we think there's more to come, more uncertainty. So some of the things we're going to go over with are how do we handle those things, and we're going to send it over to Bernie McVeigh to give us our general outlook.
My name is Bernie McVeigh, and I'm an advisor here at Akers Financial. What I'd like to do is talk a little bit about our outlook for the market as we enter 2022. It really is a transition year if you think about it. 2021 was a recovery year from the 2020 impact of the pandemic. We also felt a little bit of that last year, but the market kind of was recovering nicely. And, now we're back to what we believe is more of a long-term environment. Monetary policy is shifting a bit, however, as we've seen inflation kind of rear its head over the last 6 or 9 months. The Fed's now admitting that they don't view inflation as transitory or temporary. And we're seeing this policy shift from, which was an extremely accommodative, free money kind of environment to one where potentially there may be multiple interest rate increases this year to address the inflation in the environment. And we expect that will really give us some volatile markets. This uncertainty should lead to increased volatility, which makes investors, nervous as they see, significant swings in prices and rates and so on. Adding to the potential volatility here is a bit of the political chaos that we're seeing kind of play out here in the U.S. And we are really in the midst of an election year, as we're seeing the midterm elections where the new Congress will be selected as of November of 22. So it's an interesting market, a lot of change going on, and we do expect volatility. So we are beginning to see some headwinds show up in the market. Even though the broad market is up, there are, more than a few stocks that are actually experiencing kind of negative performance. As we are here in the first few weeks of 2022, for example, tech stocks are now struggling and are down a bit as the beginning of the year. Additional headwinds are being caused by, this Omicron variant of COVID, and there may be other variants that emerge. We don't know. The labor shortages are becoming acute in the market. Companies are having a hard time finding employees. Some of this may be being driven by vaccine mandates. There are a lot of retirements going on, and there are a lot of people that are, comfortable staying home now. And the marketplace is difficult for employers. There are pending interest rate hikes. The Fed is advertising that they are going to raise rates, and some believe that there may be as many as 4. If that occurs, obviously the market will react accordingly, and we believe that is a driver of the volatility that we're really expecting to see. As advisors here at Acres Financial, our job is to help clients develop comprehensive plans that are uniquely designed around their goals. We believe strongly in asset allocation. We believe in risk management. There are portions of our portfolio that are designed to be at risk, if you will, and they're oriented toward growth. We believe strongly also that there should be safe portions of the portfolio that are protected or risk adjusted from kind of some of the market volatilities and downside risk that might otherwise exist in a 60-40 stock and bond portfolio. There won't be safety in bonds from an environment where interest rates are increasing, as prices move inversely with interest rates. We believe strongly that there's a portion of the portfolio that should be allocated toward high quality dividend paying stocks. They're not necessarily protected from downside risk, but the proper portfolio positioning, the amount of the portfolio that is allocated there is an important factor in the overall design. And we get paid to wait if there is a temporary decline in the market as these dividend stocks pay investors for holding them. We do believe that the market is factoring in interest rate increases. So if we can get them behind us, we believe there is room for growth in the market. And we expect 2022 to be a good year for our clients. We believe strongly in diversification, so we won't have your whole portfolio at risk. We believe hard assets perform well in this type of environment. By hard assets, I mean things that are tangible, physical, things like real estate, commodities, both industrial and agricultural, precious metals. They all typically do well in inflationary times. So we're really excited to begin to talk about the way we manage money, and I am going to move us into a discussion of the Acres Financial Group select models. We have a number of portfolios that are designed for unique purposes depending on the risk level that a client that is is willing to take and we deem appropriate for that client.
All right, so now let's talk about some of our portfolios. A lot of you may or may not have seen Brookstone Capital Management on your statements, but Brookstone is the third-party company that trades and helps manage the Acres Financial Group Select model. So I want to just touch on some of those models and how they've done here recently, and just overview our philosophy really. So we have three different models currently. We have growth and income or income model. We have a moderate model. We also have a moderately aggressive model. And then lastly, a diversifier. So the way that we tend to structure these things as part of our overall asset allocation is we use something as a core, right? So a moderate or a moderate aggressive or income, depending on, the scenario, the situation, can be our core portfolio, and it's going to have exposure to, well diversified, different asset classes. And then from there, depending on what's needed to well round out the diversification, we can add on things like the diversifier as a satellite, or other things, individual securities, different things to pick up whatever exposure we need based on what's in the best interest of the client, and where their other money is, and so that nothing's being duplicated and everything's working in conjunction. So we look over what's happened this past year. The moderate aggressive actually underperformed the moderate, and that's a function of it being overweight some of the like the fintech names. So it's got an overweight to tech names, and as some of those earnings got digested, some of the run up was COVID inflated numbers, non-sustainable. So this is normal. We're seeing a kind of a reset in that space. Valuations are becoming a little bit more realistic. And typically this is inducive of a future bull market. It's a healthy thing for the market to correct, especially when it's had large run-ups in certain sectors versus others. And that's the big thing about the stock market and asset allocation, right? We want to have exposure to different things because different assets will run at different times, but it will always revert back to the mean, and we need to make sure that we are conscious of that. And that's why we rebalance when things happen. We usually let the market tell us when to rebalance. We're not going to do it just because, or if we need to add a fund in. But these portfolios have been good for us, all the way from averaging about a 10 on the income to a 20 on the moderate this past year. And then the moderate aggressive did, about 17. So we're there with market similar type returns, and we've taken way less risk because of the diversification. So last year, mid-year, we, like I mentioned before, went overweight tech in the moderate aggressive, and we added a little bit extra in the moderate. I pay, the future of transactions. We really believe strongly that fintech's going to be the way of the future, and there's a lot of unbanked people out there, but there's a lot of people with cell phones. So we're going to see that emerge over the, in the coming future. We also are trying to hedge for inflation because it's a real thing. It's no longer transitory, as the Fed would say. And shareholder yield is the way that we've been playing that. Dividends, companies with pricing power, right? So if they can pass that increased cost over to the consumer, then their earnings will increase, everything will go up. And we believe the stock market's a really good way, combined with hard assets, to play inflation. And that's a real thing because purchasing power is very, very important because it's a game of cash flows. So having a little bit in all these different spots really helps us. We're going to just go through some quick overviews of the market, and then we will get Brian back in here to wrap things up for us. So the U.S. markets this year, pretty much all up. The Dow's up 18, S&P 26, NASDAQ 21. So you see some different returns from these different benchmarks based on what stocks are in there. And it's a strange time when you see the benchmarks up so high and then some stocks being down. It's just showing things are cycling through, meaning it's like a transition time, like we've been talking about. And bonds are down. Interest rates can't go much lower, so there's very limited upside in bonds right now. It's a scary place to be a debt holder when we're in a high inflation environment. So that's just one thing to look out for. International markets, this one's kind of interesting. So the euro, that's European stocks, it's up about 20%. The Nikkei, it's up about 5%. It's Japan. Now Hong Kong is down almost 16%. And if we remember, they had a lot of unrest and different things happening in that country this year. So it just shows that while everything else is performing, political risk is real, and that disrupts economies. So we have to watch these things. Commodities and metals, I'm sure everyone knows this, but gas is up. They're saying it's because of demand. There's all these different drivers, but the price of oil is up. I don't know exactly why. It's a function of a lot of things, but everyone's feeling it at the gas pump these days. And a very strange thing this past year, but also, not unheard of, is gold being down when we have inflation. So gold's typically a good way to hedge for inflation. Now, in this case, the stock markets went up, so gold is looked at as a risk-off asset. So it kind of went down a little bit, about 4 or 5%. So we expect to see that trade return, gold to continue to appreciate as a store of value, but there's also new asset classes coming. So we have to be, looking out and seeing, okay, how are things interacting with each other? Do they still correlate the same way? So the dollar went down about 6%. So we still have a very strong dollar. I'm surprised it didn't go down a little bit more, honestly. And now we have the Treasury up almost 60 basis points. So that's 0.6% on the 10-year Treasury. And that's a sign of interest rates starting to normalize a little bit. And we think we're going to see a lot more of that coming, as the Fed has indicated. We'll just have to see how they implement and what they do and how they follow through with it. Volatile times are, never a time to panic. So that's why we always want to have a plan with things that we're doing. And that's why we always want to have asset allocation proper and fitting for everybody out there. That way we can deal with whatever's coming. Like, that's the point of designing portfolios for people, is so that no matter what happens, we know things will be okay. Any other questions, just feel free to reach out to me or email me. Always happy to see everyone or answer anybody's questions.
Welcome back. It's Brian Akers. Thank you for listening to our talk today. Thank you, Alex and Bernie, for a good job on explaining the markets of 2021 and our outlook into 2022. This year, as an advisor of the Akers Financial Group, we want you to know that we're there for you to answer your questions and to help you through the volatility that we see coming up. Make sure that we are properly diversified to handle the good days and the bad days. Akers Financial Group, in our design of portfolios, is truly designed with a protected and at-risk portfolio design in mind to help us get through whatever might come our way. Now, this year we have a lot planned. One of the things we have planned gave me is, the expo. The expo will be August the 26th on a Friday from noon to 6:30 at Water's Edge Event Center in Belcamp. Be sure to come in person on that Friday in August. Yes, it'll be in the summer before the fall gets too busy, but just a good time in the summer. It'll be air conditioned inside and hopefully good weather on the outside. Also, email us with any questions that you have, and also sign up for our weekly email that comes out with our newsletter and our write-ups each and every week with links to all kinds of different things. And the last thing here is this: don't miss our radio show on Saturday mornings at 11 a.m. on 105.7 The Fan. I'm Brian Akers, Akers Financial Group, and thank you for listening to our first webinar of the year 2022.